Welcome. So, you want to invest in your future, but maybe you feel a little lost in the whole world of mutual funds? Well, you're in exactly the right place. In the next few minutes, we're going to demystify how to pick the right funds for your goals in 2026 and get you on the path to building some real wealth. Does this feel familiar? You know you should be investing, right? But the sheer number of options, all the jargon, the crazy charts, yeah, it can feel totally paralyzing. It's a really common feeling, but the good news is there's a simple path to get you started. And that path, it leads directly to mutual funds. They are a simple, accessible, and honestly, an incredibly powerful tool for anyone looking to grow their money. Think of them as the perfect entry point into the world of smart investing. So, what is a mutual fund, really? Well, at its heart, it's basically a collective investment. Imagine thousands of people, just like you, all pooling their money together. Then, a professional fund manager takes that big pool and invests it in a whole range of assets on everyone's behalf. Okay, let's break that down. It's actually pretty simple. First, you and a bunch of other investors chip in and pool your money. Second, an expert fund manager takes all that cash and invests it into all sorts of things, like stocks and bonds. So that means the fund itself owns a lot of different investments. And finally, as the value of those investments goes up or down with the market, so does the value of your piece of the pie. Now, the single biggest benefit here, the absolute game changer, is diversification. Instead of putting all your eggs in one basket, like buying stock in just one company, your money is spread out across many different investments. This is so crucial for managing risk, because if one investment isn't doing so hot, another one might be doing great, which helps smooth things out over time. Okay, so we get the basic idea, but how in the world do you find the right fund for you? Well, there are several different types, and you can think of them like a map for your money, where each path leads to a totally different financial destination. We can pretty much break these down into four main types. First up, you've got equity funds. These are higher risk, which also means they have the potential for higher returns. They're perfect if you're aiming for long-term wealth. Then there are debt funds. These are much more conservative, so you're looking at lower risk and more stable but lower returns. In the middle, you have hybrid funds, which, you guessed it, offer a balance of both. And finally, we have ELSS funds. These are a special type of equity fund that also helps you save big on taxes. All right, let's make this real. Let's look at a few specific fund examples to see how they match up with different types of investors. This way, you can start to really picture where you might fit in. So let's say you're an aggressive investor. You've got time on your side and you're comfortable with a bit of a bumpy ride for higher rewards. A fund like the SBI Small Cap Fund could be a great fit. Small cap just means it invests in smaller companies, which have tons of potential to grow into giants. The journey might be more volatile for sure, but the potential rewards can be huge. Now, what if you're looking for more of a middle path, a balanced investor, right? Well, a flexi-cap fund like this one from Parag Parekh is a fantastic example. It's flexible, which means the manager can invest in Indian companies of all sizes, and it even diversifies by holding stocks from around the globe. This creates a really powerful balance between growth and stability. And last but not least, what if your main goal is saving on taxes while still getting some growth? An ELSS, or Equity-Linked Savings Scheme, is perfect for this. A fund like this one from Axis lets you claim a tax deduction under Section 80C of the Income Tax Act, all while your money is growing in a stock market. It's a powerful two-for-one deal. Okay, we've covered the what and the why. Now for the most important part, right? The how. How do you actually get started and turn all this knowledge into action? Getting started is way simpler than you probably think. First, you'll need to complete your one-time KYC verification. Next, just pick an investment platform, like a trusted app or a broker's website. From there, you select a fund that fits your goals and decide if you want to invest a little bit every month, that's a SIP, or a one-time lump sum. Once you make that first payment, that's it. Congratulations, you're officially an investor. Now, successful investing is really all about discipline. So let's look at a few common traps to avoid. First big one, do not stop your monthly SIPs when the market is down. I know it's tempting, but that's actually when your money buys more for the same price. Second, don't just chase whatever fund did great last year. And most importantly, avoid panic selling when things get a little shaky. The key is to have a long-term plan and just stick to it. This really is the secret to building wealth. It's not about trying to time the market or chase some quick profit. It's about showing up,
month after month, and just letting the power of consistency and discipline work its magic. Let your money work for you.
So there you have it. We've walked through what mutual funds are, how they work, and a clear path to get you started. The only question left is, what financial goal, big or small, are you going to start investing